So thank you everyone for joining us for our session here. My name is Cameron Law. I serve as the Executive Director of the Carlson Center for Innovation and Entrepreneurship, and we're excited to bring to you this fourth session of our series, diving into investment readiness and SaaS fundraising. We're in great hands today with Paul. We have Steve, we have Hendrik, and Tim, and they'll all do great introductions here in a minute or two. But before I pass it over to Paul to lead the charge for the rest of our time here, if you're not familiar with the Carlson Center, we serve as a regional hub and platform for providing approachable and accessible entrepreneurial education and community to support startup founders that are ultimately getting started and trying to scale. And this four-part series is brought to you in partnership with Tech Futures Group and is funded through the Accelerate California hub by the California Office of the Small Business Advocate. We government agencies love very long titles there. But as a reminder, we are recording this session and we will be following up with the slides. But what we aren't able to necessarily always support you with is if you have questions. So make sure bringing those in and making sure that those get answered. You're not going to be able to ask those burning questions after the fact. So use the space you have today to engage our speakers. So with that, I'll turn it over to you, Paul, and thank you all for being here, and let's have a great conversation.
Cameron, thanks so much. We appreciate the partnership. So good afternoon, everyone. My name is Paul Bozzo. I'm with the Tech Futures Group, and welcome to Investor Readiness, and really excited to bring this content to you today live. So lots to cover today in terms of our agenda, in terms of the big picture topics that we'll be talking about. I'm going to kind of give you an overview of venture capital process. We're going to be talking about how you would identify appropriate VC and angel groups to approach for funding. Talk very briefly about the SBIR, STTR innovation grants. Go over a bit of entity formation, best practices, and governance best practices. And then really what I think is the most fun part of today is we're going to have an investor speed round, and you'll be meeting our panelists here in just a moment. But this is really your training. I mean, we bring this information to you for your benefit, and you've invested the time, and so really this is for you. And you essentially have experts on the line today. If we added up the years or decades of experience in this sector, it would be pretty impressive. So there's a chance both throughout the presentation, but also at the end, to really respond to your questions, your most burning questions. And so we hope that invite you to take advantage of that opportunity. Share more about that in just a moment. So in terms of very brief introductions, I'll just start it off. Again, my name is Paul Bozzo with the Tech Futures Group. I super briefly SBA lender for 5 years. I worked with a national consulting company for about 4 years. I ran a tech accelerator for 3 years. I've been an advisor with the Tech Futures Group and the Small Business Development Center Network for about the past 15 years. In those capacities, I've literally worked with thousands of clients. A large segment of those are primarily seed and early stage technology companies. So I do a lot of work with planning, business modeling, financial forecasting, and funding. So all the topics I'm going to be covering today are things that I literally talk about on a daily basis and have for years with countless entrepreneurs. So I'm happy to be here with you today. Steve, would you like to do a brief introduction?
I'll be very brief since this crowd has been putting up with me 3 of the last 7 days. Steve Plume, likewise, a long time in technology, most of that in software. And I've been on all sides of it. I've been a consultant, I've been a founder, I've been a multiple-time startup executive, and I've spent the last 5 years in venture.
Thank you. Hendrik, would you like to share a little bit about yourself?
Yeah, sure. Absolutely. Hendrik Bartel. I'm currently the CEO of PostSeek, CEO founder. Previously to that, I was the CEO of Infima, which was a Stanford spin-off deep learning technology company that we sold last year. Before that, I was the CEO and founder of a company called True Value Labs that got acquired in 2020 by FactSet. And Steve was, along with TEF, the Entrepreneurs Fund, was one of the first investors in True Value Labs probably 12 years ago at this point, a long time ago. And then before that, I was in product leadership positions and 3 startups that all got acquired. And after that experience, I took a break, went back to business school, and thought there must be a method to the madness of building companies. Still not sure if there is, to be honest. I don't know. It's sort of like a thing, I guess. Like once you're not employable anymore, you need to go start founding companies. Not sure what this is, but yeah, we're building another one. We're actually closing funding today, so we're getting a real hands-on
Congrats.
approach on what's happening here in the flesh. And yes, we found a posting about a year ago. Have customers, have pipelines. So it's a pretty exciting vertical SaaS company. Happy to tell you guys more about that later on.
Great. Thank you, Henry. Tim?
Yep, Timothy Wong, managing partner here at the Wesley Group. We're a venture firm for almost 15 years, focused on climate and industrials and sustainability. We have 2 different funds we invest out of, a seed fund, $100 million fund that can do kind of $500,000 up to $4 million checks, and then also a main fund of $300 million that can do kind of series A, B, and C, ranging from $5 to $25 million checks. And prior to this life, my first half of my career was as an operator, so I worked in fintech for many years, kind of doing sales and business development. So also did a startup where I was on the other side of the table begging for money, and here I am again in venture, still begging for money. So happy to talk about that too at some point. But good to meet you all.
Perfect. Thank you. And we're super appreciative of Henrik and Tim joining us today and taking the time out of their busy schedules to share their knowledge with us. So thank you both, as well as you, Steve. So bit of disclaimer. This is for educational purposes only, and we are the first people in Tech Futures Group when we're advising clients is to seek out licensed and qualified legal and financial professionals for all big decisions related to your company. But here we go. So again, as I mentioned, this is going to be at the end, but I wanted to give you kind of a preview so that as we're going through the conversation and just in general, you have some time to really formulate your questions. And hopefully, Cameron, I can't see the screen, but I'm assuming we have both chat and a Q&A. So if you have questions, either jot them down to the side. You're welcome to either put those in the Q&A or chat, and also real time. So we're going to have a dedicated time at the end for all the questions in the speed round. But again, as I'm going through the topics, if you have specific questions, pop those in Q&A, and Cameron will break in and alert me if we have any specific questions. So lots of open time for both color commentary from our panelists as well as your questions. So we really want to make this an engaging, multi-directional type of training environment. So let's talk a little bit about venture investment. So when I thought about assembly, I do a lot of trainings. And when I thought about this particular training, I said, this is a real opportunity to share a lot of information. So there's going to be a lot of information coming at you today on a lot of different topics. And I thought it was an opportunity when I was assembling the webinar is to really share with you all the things that I deal with every day working with startup tech entrepreneurs related to funding. And so I thought back over the last 20 years of my experience and thought, what are the common themes that keep coming up and up in terms of questions that entrepreneurs have, roadblocks entrepreneurs hit, misconceptions or plain untruths that they believe are at play in the funding world. So I'm going to hit you with a lot of stuff. It's my best stuff, and this is why we have our expert panelists, because there's never a one-size-fits-all solution. There's lots of gray in these topics and lots of different approaches. So I'm going to share my best stuff, but again, I would invite our panelists to share their perspective and perhaps how they view some of these topics. So I've also included links to vetted, reputable resources for articles that can get you started on each of these topics for some additional information. So here we go. So first, the big myth, venture capital is the primary source of startup funding. Not really. Pure institutional professional venture capital typically comes in at the mid or later stage of a company's development. And we'll talk a little bit more about that. But, when we think about terminology, it's very specific. There is terminology related to an accredited angel investor, to an angel investor, and to a venture capital investor. And oftentimes those terms are kind of mixed around, and it's actually important to kind of structurally know what a VC is versus an accredited angel is versus an angel investor. So here's the truth, and this is based on vetted research from reputable sources. It's not just Paul making this up. Venture capital financing is actually, in a broader sense, the exception. I mean, a very small percentage of startups actually truly raise institutional venture capital. Non-venture capital funding really is the biggest part of the ecosystem, and it's the primary funding mechanism, particularly in the early stages of startups. Angel investors, and we'll define that term more, actually invest at the earlier stages of a business prior to venture capital traditionally. And angel investors invest smaller amounts of capital at earlier stages. And they actually, from a numbers point of view, 16 times more companies than venture capitalists do. So it's a bit of a pyramid and a funnel, if you will, in terms of the funding sequence. So it's helpful to kind of understand what stage you are. So as I kind of go through these definitions, and again, there's some gray. These are not absolute and the only definitions, but it's a starting point as for reference. I want you to kind of think, as I describe each of these stages, kind of where are you at? And that's actually important to know the appropriate funding source. So pre-seed is, you've got the idea, you've maybe got a business plan, the team is forming. Seed stage, typically prototype, maybe MVP, some initial market testing. Early stage, beta, you've got some initial customers beginning to drive some revenue. Expansion starts that hockey stick where you're past the early adopters into your core target market and you're expanding both user base and revenue rapidly. And the maturity typically is really, that's where the profitability happens. And you've really achieved a significant dominant market percentage. So I want you to kind of think, where are you in that and how would you classify the stage that you're at? The reason it's important is now let's think about who the most appropriate funding is by stage. Now, there are always exceptions. So for example, you could have a extremely talented entrepreneur, deep connections in Silicon Valley. It is their fourth startup. They could potentially get VC funding at the pre-seed stage because they've been there and done that. They're a known quantity. For the vast majority of founders, though, that don't have those type of pedigrees and credentials, typically it goes like this. Pre-seed is typically you and your team's money, friends and family, aka angel investors, some non-dilutive capital in the form of grants, and that can include innovation grants. Seed stage is typically, maybe a second round of friends and family, larger grants, SBIR phase 1 and phase 2. Early stage, now we're into actually accredited angel investors, and we'll define that in a moment. Early stage VCs, perhaps later stage SBIR grants. We'll talk about SBIR later. And then expansion, you get into primarily more institutional and strategic capital. And then at maturity, it's a lot of late stage VC, SBA, mezzanine, and strategic. So most of the companies I work with are in the pre-seed, seed, and early stage, and also some expansion.
Hey, Paul.
Yeah, go Steve.
Before we leave those two slides, since we've got Tim on the line, there, as you've said, there are lots of exceptions and shades of gray. Tim, on this slide and the prior one, would you say there's any evolution going or changes in kind of the center of the bullseye in any of these definitions?
Yeah, I think yes and no. I think, these are mainly the right stages. I think what has changed over time are just expectations. I think, the size of each of these stages has changed. Pre-seed used to be maybe $1 million. Now I've seen like $20 million pre-seed rounds. So that's kind of wild. I think the second part is, some expectations around when you should have some revenues, depending on your technology and where you are. I think, more is expected of folks at an earlier stage than it was 10, 15, 20 years ago.
So one of the things I've been talking about over the last 3 webinars is, at least in my experience, the days of 2 guys with a neat idea on a whiteboard. That's not fundable anymore. It was when I hit this valley, that was how most companies got funded. But unless you're in the corner case Paul just mentioned, where you've done it 4 times already and made people a lot of money, that's just like not an option anymore.
Yeah. Yeah.
Right?
I think that's right.
Okay.
Although technically our firm just did a deal of 2 people who are former Google X. So they're very technical. They're obviously at a pretty important, pretty big place. They had just a pitch deck and they raised a pre-seed. So kudos to them. That being said, it also comes at a price. So you could be the 2 people at a garage, but you're not going to get the price that, that was probably going to be given to you in 2021. We're at a different place in a different market. And so there's always a trade-off.
Yeah, fair enough.
Great.
Okay, thanks.
All right. No, thank you both. This is great. This is exactly what I want, is that perspective and additional commentary. So perfect. Thank you. If you are at technology readiness level, and I'll talk about that, is a term that's often used, I wouldn't say primarily in the government space, but often in the government space. If you'll be going after government innovation grants, knowing your TRL level is actually very helpful. So this is another way to kind of categorize what stage you're at. So for example, if you look at stage 1, essentially it's the research stage, stage 2 as well. Stage 3, you're moving into proof of concept and up the line. So if we think about potentially approaching government agencies, if you've got any technology for clean tech, biotech, Department of Defense applications, knowing your TRL and knowing what the system is potentially very helpful for you. So what is a venture capitalist? Let's make sure that we define that term, because it's very specific. A venture capitalist is a professional money manager. It's a private equity firm that provides capital to companies with high growth potential in exchange for an equity stake. So if we think about a venture capital, these are professional paid money managers that go out into the world from trust funds and other entities and do calls for capital. They build a fund, and it's their job essentially to invest the proceeds of those funds for the highest return, risk-adjusted return on investment. So again, these are professional money managers investing other people's money on their behalf for an above-market risk-adjusted rate of return. So why do venture capitalists invest in startups? The reasons are numerous, but primarily it's making a significant, and I'm going to actually replace significant with risk-adjusted superior return on their investment. It's high risk, high reward. I mean, there's often a statistic that goes around that, anywhere between 50 and 75% of VC investments either pay nothing or maybe 1x. They're really looking for those grand slams, the 10x type of return, the exponential company, because they need those companies in their portfolio to balance out all the ones that may not make it or barely survive. So when you approach a VC, you have to have a really high potential business model, dominant market position, ability to scale, and really prove that you're going to be the exception to the rule in terms of success. So exit strategy, and actually I'd be very curious to get some input from our panelists on this, because I often get a question when I'm helping a client with the pitch deck is, do they talk about exit strategy, or is that a big thing at the initial presentation to a venture capitalist? So I'd be curious to get some thoughts from our panelists after this. But if we think about liquidity, so oftentimes entrepreneurs are worried about getting money in, your investors are actually worried about getting money out. And so structurally, how does that happen? There's multiple ways, but three primary ways. You can certainly go public. So all of a sudden, the shares of the company that are privately held have a viable market mechanism to liquidate those shares. Merger and acquisition is also possible, or liquidation also is an exit strategy. M&A, or merger and acquisition, represents the most common route for VC exits. And according to statistics, accounted for nearly 70% of successful exits in 2022. Why is that important for you? The question is, do you have an exit strategy? Do you have a clearly defined path to essentially return liquidity to the initial funder? So Steve, Henrik, Tim, any thoughts on whether a company having a clearly defined exit strategy is important to pitch to a VC?
I'm happy to go first real quick. I think it depends on what stage you are. I think that there's a part of me that says you got to be practical and kind of know where you're going to be. I think everyone that we talk to in the initial pitch will say, I want to go public. And while that, is usually the goal you want to go for, as the data shows you here, is, probably over 70% are M&As. I think even if you don't mention or not, we as investors will always ask that question, like, how big can this get? That's a fundamental question that we will always ask ourselves, and to say, is it going to be worth that investment, depending on the size of the exit?
Okay. Any other thoughts from our panelists?
Yeah, I think just from sort of like practically speaking, 2 ventures ago, True Value Labs, where Steve was an investor, and we worked on that together. I think we didn't have a clear exit strategy in the beginning. I think we started forming and ideas of an exit strategy sort of like 4 years into it. And 4 years, so the difference with that venture and the current venture is the advancements in technology. So for the first venture, it took us about 4 years to sort of like get to product market fit, and to sort of like get the technology where we wanted it to be, according to the vision that we had of the company. And then once we were market ready, and that took us 4 years for that venture, 3 to 4 years, we started, all of our customers were potential acquirers of the business. So I think at that point, sort of like with the first big check coming in from a customer, but also B, from a venture investor, I think that's when the conversations around possible exits started to form, and where the journey might go. Then the exit that eventually happened was very much informed by the stage of the company, the interest of the company that we had created, the velocity of sales, et cetera, and so that was then the exit of the company. The current company that we're building, I think we were a lot faster on getting the technology to where it needs to be. So it took us about a year to get the technology right, get the product out, build a pretty material, substantial sales pipeline. All of that filtered into sort of like the round that we're currently doing. And I think I took a lot more thought into like what the potential exit is of the company much earlier, from a look at the TAM. I think, and this is sort of like a healthy therapeutic discussion here for me as well, having Tim on the call here. Like, listen, and when a VC asks me, is like, all right, so are we going IPO? Like my standard answer is like, look, I'm not a IPO CEO. That's sort of like not what I had written on my journey card for my life. Like, take a company from zero to all the way to IPO. That's like, I think the technical term here is, and sorry for everyone on the call, I think that's a shit ton of work to take a company from zero to absolute crazy IPO. And you see, like, that's a very, very coveted club of people. Like, becoming a CEO of a publicly traded company, that's a whole different journey, a whole different ballgame. But like being the CEO to take a company from zero all the way to IPO, that's a tall calling. And my honest answer is like, sort of like, I never had that on my calling card. Sort of like, that was never my dream. I'm starting to see that could happen with this company that we're currently building, because we're seeing that the market opportunity is just so like so large. However, we are already seeing in the customer conversations and in the partner conversations and the distributor conversations that we're having, everybody is already there. It's like, okay, what's the journey of this company? Where are you going with this? And we're already dealing with one of the existing customers from 2 companies ago that wanted to actually acquire that last company. And they're now already back at the table and they're like, all right, they're showing full on FOMO. It's like, okay, how can we preempt even more funding going into this company? Can we just go do a deal right now? And again, my standard answer there is like, no, we need to create value first. So I think it is a healthy, from a founder's perspective, it is a healthy sort of thought exercise to at least understand where the journey could go. And it's sort of just making sure that you have thought around this and thought it through. But I'm not driven by an exit. I'm driven by creating value for customers, employees, and shareholders. That's my drive.
Perfect. Thank you. Thank you.
Paul, can I just riff on this for just a
Go, please.
Because I think they connect in an interesting way. Hendrik's closing comment of he's trying to create value and grow a company that has meaning and value. My current role, what I get is feedback from multiple VCs about multiple companies, right? Because my CEOs go out and they make 5 pitches and they come back and they tell me what they heard. I think in the early stage, which is where Hendrik is, I think the typical what the investors are looking for is not, oh, I'm going to go public or I'm going to sell to this company. It's I'm going to build a big important company, because there are going to be roadblocks and there's going to be 2 or 3 more funding rounds. And by the time you get to Series B, I don't know when the IPO window in the United States is going to open back up. And I don't know if it's going to be in my lifetime. So by Series B, you definitely ought to be thinking about who could be on the exit path. And so two do's and a don't, right? So, do intend to build a company of high value. Do have some very clear possibilities in mind, and don't, as I see way too many draft texts come through, say, oh, Google, Facebook, or Amazon will take us out. No, they won't. That just means you're lazy and naive and arrogant. Don't say that unless you can really, really, really explain why that would happen. Okay,
great. Thank you all for some great thoughts on that topic. So let's move to an angel investor. So we're moving from a professional paid money manager to an individual who invests their own money in a startup in exchange for equity. And angel investors are just real people. They could be entrepreneurs, business people. They could be, really anybody. The classic definition of angel investor is really any individual investing their own money in a company in exchange for equity. So there's a couple different flavors of angel investors. So what we think about is really angel investors. We tend to use that term in that first round, the kind of friends and family round. They don't necessarily need to be friends and family, and hopefully they'll still remain friends and family. But they're typically on the first phase of the funding. The next phase typically happens from what are called accredited angel investors. There's actually a definition according to the Securities Exchange, but broadly, they're individuals that typically you don't have a personal relationship with, at least initially. Oftentimes, they tend to be fairly savvy in terms of business and financials. They understand the risks and reward of investing in startups. Most of your friends and family will not. It's your job to make sure to educate them. And they're typically higher net worth, both in income and assets. Now, you'll notice the link on the bottom. In several of these slides, I actually link to a vetted, reputable article that tells you more about this company. So you will get a PDF copy of this presentation. The links will be live, and there's a number of great articles I've assembled as part of this presentation so that you can learn a little bit more about the topics on each of the slides. So I encourage you to do some additional research and take advantage of those links. So why do angels invest in startups? Oftentimes the motivation is similar to a venture capitalist. So they do want a risk-adjusted return on their investment. But also times angel investors may have a particular affinity or expertise for the technology or mission of the business. So the tech accelerator I ran was primarily a clean tech accelerator. And a lot of the investors in those companies certainly met the criteria of being an accredited angel investor, but they also they were kind of mission or values aligned. And that was really what I call the icing on the cake in terms of allowing them to invest in our company. So when you are vetting and looking for potential accredited angel investors, also think about where their values are and perhaps if your company's mission or technology could align with an affinity that they have or expertise. So if we think about some averages, and again, these are very broad, very, very broad. There are many, many exceptions to these rules. The classic kind of first money in, which would be friends and family. Oftentimes those checks for individuals can range between 2,500 and up to 5,000, 50,000. Really, a lot of the friends and family rounds I do tend to be 250,000 to 500,000. The checks can be 10,000, 15,000, 20,000. So it ranges, but that gives you an idea. When we move up the food chain, if you will, the investment food chain, and we're beginning to work with accredited angels, typically they're investing $25,000 to $50,000 per angel, sometimes more. And angel investment groups typically fund deals between $250,000 and $1 million. Again, there's a lot of variance with that, but that gives you a general framework of how that works. Great article all explaining about different rounds and what their structural parameters are. When we talk about classic institutional venture capital, again, these are various ranges. So I used some information from Statista. 2023, I believe these are from. Average seed stage was 2.6, early stage 6.8, and later stage 7.6. So the thinking here is that when you pitch a VC, your company needs to be structurally at a point where it can really take on 2.6 million and deploy it efficiently. So what does the venture capital funnel look like? And this is similar to an angel group. Really, all angels and venture capitalists, the thing that they want is what's called quality deal flow. If you ask an accredited angel investor or venture capital what their big problem is, lack of quality deals to screen. So that's the left side or the blue part of the funnel. And essentially, once the company gets in that funnel, they go through a series of vetting processes. Typically, there will be a first primary screening just to eliminate stuff that just is an obvious not fit. And then the companies that make it past that do first level kind of screening by one of the partners. Companies that look solid after that typically are invited to pitch. A number of companies or a percentage of those companies will be invited into the due diligence round. And then a percentage of those companies will actually get a term sheet, and a percentage of those companies will actually close a deal. So it's yeah, go.
When I was looking at the deck yesterday, I really wanted to ask Tim here. Tim,
Yeah.
could you put some round numbers on this funnel and adjust it?
Yeah.
Adjusting for the Wesley group to different stages, that's great. But how many come in, how many do you with, etc.
I'll give you some high level numbers. So on the number of deals we kind of saw last year was just over 3,000 total.
Yeah.
And the end of the funnel on the opposite side, I think we did like 4 deals total last year.
Yeah.
And so kind of in the term sheet, probably we're at a dozen or so, maybe a little bit more than that. On the diligence side, you're thinking about 50 plus 75 active opportunities, probably a couple hundred, 200-300. So yeah, it's a very quick whittling process.
That's some sobering, really good perspective. Yeah, it's very competitive.
So that's one out of 1,000, folks. This was not done at home. This was not preset. Go back to my very first slide where I told you 1 out of 1,000 we get an institutional round last Tuesday. There you go.
Yeah, we didn't collaborate ahead of this. I didn't share the data. So
Yeah. Great, thank you. So I'm just going to review this very quickly. You know, what does the actual process look like? And I'll just kind of go through these briefly. You've got the pitch, the business plan and financials. Typically you are, from your point of view, you want to have your pitch, your business plan and your financials prepared. You're looking for potential qualified investors. You're doing initial outreach to assess interest. Typically your whole goal is to get the pitch. One thing I will share, sending decks is never to your advantage. I mean, there are moments when you will be requested to send a deck, and yeah, you want to send a deck, but it's very hard for a deck to really give all the context and engage. So you are always angling to try to get a way to actually present in person, over Zoom, however you need to do it, but to ability to use the deck in an engaging two-way conversation, well to your advantage. If they like the pitch, the investor typically will schedule additional meetings, more detailed review of the business plan, particularly the financials, the team. You'll enter into due diligence, which is essentially an examination and verification of everything that you've told them and more. If you're lucky enough to get a term sheet, you'll do that. If you're happy with the terms and you close, you'll do the documents and then you get the funds. So that's just a quick overview of generally how the process works. I get the question a lot, like, how long does this take? And actually the structural process of an entity developing, say, a safe note and getting that signed and getting checks and all that, you know, that could be a few weeks. The real time it takes is to identify, engage, and go through the process. So really the bulk of the time is not in the tactical part of actually structuring and securing the investment. The bulk of the time is identification, outreach, arranging pitches, following up, due diligence. That's where most of the time is taken. Good. Team. And I'd love some comments from our panelists about this. But there's a great survey of 885 venture capitalists, and essentially they said 681 of those firms, so out of 885, 681 firms said team was an essential factor in their process. So in addition to fit with investment strategy, product, business model, those are all important, but 95% of those VCs surveyed said that team was one of the most essential factors in their decision to invest. And what I'll add briefly before I open it up to our panel about this is that that's even more important at the seed stage because the business really isn't fully formed yet. And so at that very early stage, investment is maybe less in the business and it's really more in the team and the belief that that team can actually execute the plan. So I would say this is of paramount importance in the earlier stages of a business. But panelists, any thoughts about what you guys look for in a team?
And I'll go first if you want, but I'd want to hear from Tim and Hendrik as well. I think, again, this has changed over time since I first got involved in the industry, right? There was a lot of emphasis on enthusiasm and creativity and energy and especially youth. I think now the team's got a couple of higher and different bars. One is this the team that is going to be resilient and flexible as the inevitable stuff hits the fan? You know, whatever plan you're presenting in your pitch deck is just one version of what's not going to happen. How is the team going to adapt to what really does happen? What I think that means is two things. One is you've really got to have domain expertise. And whatever you're doing, you can't just come from, I don't know, college and go do a deep networking thing. I mean, maybe there are exceptions who can, but it's not probably the great idea. And then the second, and I'd be eager to hear Tim's comments on this. My experience is if you're coming in with an idea 90 days on either side of you, 3 or 4 more companies are coming in with a similar idea. Not identical, but it's pretty much in the same space. And the VC can invest in one of those companies, just one. So part of it is your team has to convince the VC that of the half dozen companies in a roughly similar space, this is the team he or she wants to bet on. And that's a high bar to get over.
Other thoughts on the importance of team?
No, especially like you said, Paul, at the early stages, it's even more important. And the reason is, you have to be resilient. You have to be able to zig and zag just because there's going to be a lot of changes. Maybe the product that you had on day 1 won't be the product at day 10. And, it's just so important that you have the right team in place for us to back because that's everything at the initial product stage. Later on, of course, you use Excel to optimize and do what you got to do. But at the very early stages, it's about the resiliency and character of those people before we put that money to work.
And yep, real world example here. Same team, third time around. So it's same team, and we all share the same brain defect. So yeah, no, it's same team. I think like in the beginning, like when we went for the VC financing for the very first one, it was obviously I was 15 years younger. So I'm trying to keep the good looks and the boyish charm, as that first investor said.
Started when he was 10, don't worry about it.
But the other part is also the founding team, do they listen? Can they change course? Do they understand homework assignments in terms of sort of like answering investor questions? And when I say homework, sort of like not go do your cursive or something like that, but here's a hard question. How would you wrestle with that question? Like show us that we can work together and that you can sort of like, I guess resiliency is one of the words that could describe that. Or are you flexible enough to change and zig and zag and change course and because this is not a straight line journey. This is like a slalom uphill.
Let me pick up on a question in the chat from Mark.
Yeah.
About the skills and nature of the team members you need to add. Yeah, no one expects that you've got every skill in every person in your company at a seed or pre-seed or even Series A. But one of the questions you're going to get is, if we give you this money, who are your next critical hires and why? And you should really, and that doesn't necessarily mean, it's going to be Polly Jones, but it's going to be a CTO, or it's going to be an engineer who knows in depth of, TCP/IP embedded in silicon, or, whatever it may be. But absolutely know what the missing skills are and how and when you're going to add them.
Great. All right, thank you. Due diligence. Briefly, let's talk about this process because sometimes this is when the deal is either made or done. It's essentially the process that the company goes through, or the investor goes through to really evaluate and vet all the aspects of the business. So it's an examination, the management, the resumes, the market potential, the product. You can actually Google due diligence checklist, and you're going to see that essentially it's the ability of the funder to really do a deep dive into every aspect of your company to learn more, to vet, to verify, and to make sure that what's under the hood, if you will, meets their expectations. So making sure that you've got a good due diligence strategy and that you've got your documents in order and the ability to have those documents verified and vetted is very important to actually getting through that funnel. So just briefly, a little bit on structure. There's a lot of different ways to structure an investment. What has been very popular of late is what's called the SAFE note. You have probably heard of it. Simple agreement for future equity. It was really started by Y Combinator as a simple template that startup companies can use. That's very efficient from a legal point of view, very quick to deploy, very flexible, and it's similar to what's called a convertible note, but essentially it's not a debt instrument. So I won't belabor this. There's a ton of information. There's a great article and a link to the Y Combinator, but just know that there's a simple way to structure these initial rounds of funding that save a lot of the questions around valuation and more complex questions at earlier stages.
So these safes go in
Yeah.
waves of popularity, I think.
One more time.
Safes go in waves of popularity. They go up and down with time. Tim and Hendrik, from an investor and an entrepreneur point of view, what's your current thinking on safes?
I think they're in our minds as investors, sometimes we view that as very much founder friendly to some extent. So my counsel is usually like, I hate safes because from our perspective, that's the angle. I think at the early stage it makes sense. There are certain terms around there that we can do in terms of caps and whatnot to adjust accordingly. But I think it's a good tool.
First time around, we did convertible notes. They have sort of like come out of fashion, and now it's safes. I find safes easier to deal with because it's much quicker, much shorter paperwork, and it's the language, the legalese is much easier to understand for both parties, whereas a convertible note is a much longer or stronger document. I find it, as an entrepreneur, I find safes easier to work with, but again, hey, convertible notes, they will probably make a resurgence eventually.
Yeah. And just in closing, and thank you for the commentary, is, sometimes you can go with your deal and ultimately you're going to respond to the funders deal terms. So, you can come in with the plan, but then you may have to
golden rule
reevaluate. Good. So let's do this. I know we've got some questions, and I just want to check in on time. It's 12:48. We absolutely want to conclude no later than 1:30. There is some more content. It's more. I really enjoyed this conversation. This was the heart of the conversation. I'll move through those topics relatively rapidly because I do want to make sure we save time for the investor panel and some questions at the end. But maybe Cameron, do you see any burning questions in chat or Q&A that you feel is appropriate to bring up now?
There's a couple that are maybe, before, just they're more related to like manufacturing and or like a hardware company. So I know we've had some of the SaaS examples, and then one related to strategic value of team. So I don't know.
Do you want to
Mark,
maybe,
Mark, if you
would you like to select maybe one of those, and we can at least address that one right now?
Sure. So I think this one came during kind of the, the business model of investors. And so is there ever, in kind of building a scalable company, buybacks or distributions of return on investment, so dividends, and that way for an investor to have capital come back?
Maybe I can take this one, and then happy to have the panelists contribute. So in my world, I also deal with a lot of what I call Main Street businesses. So local breweries, restaurants, wineries, yoga studios, these type of things. So I also do advising for those type of companies. Those are kind of the classic friends and family rounds. They're often 150 to 500,000, but they can be close to $1 million. I mean, if you think about a brick and mortar full service brewery and restaurant in downtown USA, it's close to $1 million to get that thing started. So the rounds can be large, but they're primarily from truly friends and family. And in that case, it's often not IPO. Of course, structurally it doesn't work. It's often not an acquisition. And in that case, a return on investment strategy that is through cash flow, is through dividends over time, is totally appropriate. So I would say that, broadly speaking, if we think about a scalable technology company, that may be M&A acquisition. If we think about a true friends and family round for specific business models, you could absolutely create a viable return on investment strategy for that type of investment pool. So I hope that helps with the question. I don't know if our panelists had any other takes on that. I think we're good. So yeah, so Cameron, let's do this. In the essence of time, we're at 12:51. let me move on. Let me address some of the other topics quickly. I'm not going to rush, but I want to move them expediently. There's links to a lot of resources for follow-up because I definitely do want to make sure we have a bit of time for our Q&A panel. Good. So briefly, let's talk about actually how you vet VC and angel groups. All accredited angel groups and venture capitalists have what I call an investment thesis. And hopefully they've made it public and it's on their website, but most of them specialize in specific sectors of expertise. They have specific funding amounts or ranges that they typically specialize in. They have a preferred stage of a company that they invest in, and also a market potential. So when you are looking at potential venture capital firms and angel groups, it's critical that you understand, excuse me, their investment thesis so that you're not wasting your time. You actually are you want to be quality deal flow. You want them to look at your pitch and think this is quality deal flow, because that is going to get you through that first round of the funnel. And so make sure that your company aligns with the investment thesis of the individual funder. Briefly, you guys, there's a lot of SaaS sectors, so it's helpful to broadly think about, we are a cloud or we are a SaaS company, and our particular niche is this. That helps you kind of define your company and actually helps you make sure that you match up with the specific investment thesis or focus of the funder. So I won't do a lot of this right now, but an example of a VC group, you could look at a company like Sequoia Capital. An example of a accredited angel group would be something like Band of Angels, and there's links to their site just as a reference point. One thing I do want to share is that oftentimes the founders have either exhausted their existing connections or they need, they don't have a lot of existing people to reach out to. So I get a lot of, I'm going to mine LinkedIn, or I'm going to buy a list and I'm going to send out a mass email. And so I get these every day. And I've just archive them or delete them or spam them because I usually get 3 to 4 a day. And I can tell in the subject line what it's going to be. It's going to be some solicitation from a company looking for funding. So I would argue that potentially that can be successful. There are times when that works, but I would also argue that it's better to actually evaluate the VC firm, to actually look at their investment thesis, to look at their team, to identify the individuals responsible for vetting companies in your sector, and to somehow find a way to connect with them individually or to develop some type of rapport or some type of referral to them. So blind emails, while statistically possible to work, I wouldn't say that that's particularly effective. The higher that you vet your VC group and the better job you do in identifying the individuals responsible and the ability to connect with them directly and personally is going to increase your chances of actually being seen and taken into the funnel.
And
Paul,
yeah, go ahead.
Oh, we have a lot of thoughts on that. What do you guys think?
Yeah, this is again from a founder's perspective. Picking the right VC is sort of like dating. You want to find the right partner that you want to go into long-term relationship with, and you also want to figure out how they fight with you and how the honeymoon phase is going and all that kind of stuff. The other part here is how, and again, this is sort of like it just irks me, like when a VC asks me how can I be helpful. Well, if you don't know how you can be helpful with the company that I'm building at this point, then and sort of we probably don't have a lot to discuss here. I think you need to really think about how that VC can be helpful to you as an entrepreneur. So you need to sort of like have that hypothesis out of their existing portfolio, out of the expertise that the partners have, and you need to really bring them during those first meetings. Is like, okay, aside from your money, and the money is a commodity that the VCs have, the money is a commodity, the expertise is the specialty. It's like, okay, how can I use you, Mr. VC, as a connection to get to that next point, or to help me understand a certain problem that I'm trying to solve in the marketplace, and then put them to work or help them to help you solve that certain problem. So I think that that's a very, very big piece for me. Again, money is the commodity here. And then lots of the larger mid-sized to larger VC firms, they come in with like, okay, we have recruiting services and we have consulting services and all of those sort of like fringe benefits, I call it. And that sounds great. And if you're a first-time founder and if you're going in there and you don't have a network, you probably take advantage of those recruiting services, etc. But I think where really the rubber hits the road for me, it's sort of like, all right, do you have expertise in having built a certain thing before or having done that multiple times, so that I don't have to sort of like reinvent the wheel? If there's a certain playbook, then let's figure out what that playbook is, and you come in here not only with your money but also with the expertise on playing that playbook, and let's go from there. That's a very important point for me.
Yeah.
All
So
right,
I'll
great.
go back to your email for a moment, because this is one of my pet peeves too.
I'm sorry. What was that?
Can you go back to the email for a moment?
Oh, go.
Yeah. Okay. I get half a dozen of these a day as well, which is really funny because I'm not currently investing in any way. Which is like, okay, you missed the first cue. But if you go and look at my LinkedIn profile or the fund's website, I am an enterprise SaaS person. That's what I do. And I can't tell you how many emails I get that say, based on your experience in cannabis, based on your success with medical devices, based on your success with alternative energy investments. It's like, guys, do your homework.
Yeah.
Okay. If you've got a cold outreach to me, if you can't find someone who can introduce you, at least say, hey, we share a mutual friend in Paul Bazo at LinkedIn. And I know by looking at you that you're interested in B2B SaaS, and here's what I've got. Okay, that one I might read. But the based on all of your success in cannabis just isn't going anywhere. Delete, delete, delete.
Yeah.
Okay, rant over.
No, it's all good. So connection is key, and research. I'm a big fan of the elevator pitch. Again, it's interesting when you ask an entrepreneur, tell me about your company. They just go on and on and on, or they stumble and fumble. And when they, just make sure that you've got a clean, quick way to essentially tell your story. What's the problem? What's your solution? What's your business model? It doesn't need to tell them everything, but it needs to pique interest. Getting to the end of that funnel is a series of milestones. The first thing you do is pique interest. And maybe that's your first job to get the pitch. So it's a series of milestones that you need to move through. And that quick, succinct elevator pitch is really an incredibly valuable tool that you can use over and over to engage people about your company. And I've included a really good article on startup elevator pitch examples, how to develop those, and some great examples. So please get your elevator pitch figured out. We'll skip questions for the moment. The rest of these topics are actually a little bit more tactical.
Can I go back, Paul, to that one email, that slide about the elevator pitch? I think that's very important. I also would argue, I don't know how many times, Steve, I don't know if you've ever dealt with this. It's like I'll be in a meeting with an entrepreneur and they'll talk for an hour or 30 minutes and not show a slide or two. I think that's just super important, for at least from my standpoint, is to walk through your product or your company or solution and go through the slides. You can't just be talking in circles for whatever the Zoom hour is. And just as a side note.
Yeah, I think a corollary to that is the only purpose. I mean, Tim, tell me if you think I'm wrong here, Hendrik, but the only purpose of the first meeting is to get the second meeting. That's all you're doing. Okay. And to go back to Hendrik's dating analogy, unless you are extremely inebriated and in Las Vegas, you are not getting married on your first date. All you're trying to figure out is, do I want to see this person again? And it's going to take a while. I mean, Tim, kind of the mirror question for each of you. How many meetings on average does it take before you give a company a term sheet?
Yeah.
And hence, how many meetings on average did it take before you got a term sheet?
Yeah, I'll go really quick. I think, my general advice for folks, especially if you haven't done this before, is you need 6 months to fundraise. And, I think the quickest we've ever done is 2 weeks and like 6 meetings in those 2 weeks. And I think sometimes the longest, my first deal actually took me 6 months to get through my own committee. And that took probably well over a dozen meetings. And then so, it really does have that range.
Yeah, there you go.
All right, good. So I briefly just want to make sure that you know about this. So this is the SBIR Innovation Grants. And essentially SBIR is Small Business Innovation Research. SBTTR is the Technology Transfer. And it's a huge source of funding for a startup company. They provide over $4 billion in awards each year to small business. And there's a link to the SBIR site, but essentially this is government innovation grants. And essentially it's got 3 phases. Phase 1 is up to 200,000 for really research, R&D and validation. Phase 2 is primarily prototype and early in a plan to commercialize. And phase 3 is commercialization. So if you are either in the R&D stage or initial prototype development of specific technologies that various government agencies may find attractive, it's really worth it to investigate the SBIR program. Here's the best, the least known secret to get in is the NSF, National Science Foundation, unsolicited pitch option. So most times you're responding to a grant, specific grant, but NSF, which is a huge funder, actually accepts unsolicited pitches for their funding. So you can actually very quickly, it's a fairly condensed proposal, send it in NSF, and they actually respond and invite you, if they deem suitable, to prepare a larger pitch. So again, I encourage you to check out the NSF project pitch page and see what that's about. It's a great opportunity. Grants.gov is the kind of clearinghouse of all government grants. It's a bit of a bureaucratic minefield, but again, if you feel like you have technologies that may appeal to some government agency, I think it's really worthy to at least investigate that option. And you can go to grants.gov to kind of find out what's available. So I'm going to skip questions for the moment. And I just want to do a few topics on entity formation and governments, because it's a common question and point of discussion with the tech entrepreneurs, and it's often done incorrectly, and there's problems structurally later on because of what mistakes a company might do in its earliest stages. So legal entity, that's where it all starts. Essentially, it's the formation of legal entity. Companies may start as an LLC or something, but essentially most venture capitalists or credit angels really will fund primarily C corporations only, rather than LLC. So if you are an LLC now, most likely at some point you might be asked to convert, or you'll need to convert. So most companies, if they are securing accredited or VC funding, will find themselves in the form of corporation rather than an LLC. Here's a great article on kind of the what each type of entity is, its pros and cons, and what might be appropriate for you. Delaware C Corporation is the favored state of incorporation. There's a couple different reasons. It's got a very well-established corporate legal system, one of the oldest in the nation. And it's got a separate judiciary just for corporate law. And so most publicly held corporations, most VC-backed companies are formed in Delaware because of the really tried and true framework and process that Delaware uses for governance for its corporations. So you can find out a little bit more about that article of exactly why Delaware is preferred for most VC-funded companies. 80% are in Delaware. So board of directors, very, very important decision at multiple points in the company's progression. But essentially, the shareholders appoint the board appoints the operating officers report to the board, and the board works for the shareholders. So essentially, getting the right startup board, getting the right composition, the number of directors, the type of directors is very, very important for your company. So again, here's a really good article on how to build an effective startup board and what those would look like. Super brief panel. I want to keep the conversation fairly tight at this point, but any nuggets of wisdom on forming a really good board at the start of a company?
I mean, I'll go. I think it's
go.
And Tim and Hendrik should
Yeah.
jump.
Yeah.
My vote is small.
Yeah.
Make sure you have an outsider. And someone who's not either an employee or an investor. And then every time I have seen founders hold the line and insist that the founders retain a majority of the board seats, it has been a catastrophic train wreck. Their thinking was, we'll maintain control, we'll maintain equity, we'll make sure no one kicks us out. And they have driven the company straight into the ground at 100 miles an hour every single time. That's why the professionals exist. Invite them in, please. Tim, you laughed twice.
No, I think we're talking about the same deal here. So
we're only one.
Yeah, I know. But I completely agree. I think this is a real good case of like less is more, especially on the early days. I think 3 is enough for the longest time. Maybe at Series A, you get 5.
Yeah.
And keep that for as long as you can as well. And because, just as Enric was saying, you got to pick your right investor. It's a marriage. Same thing with this group, right? These are the folks you're going to want to seek advice from. You're going to want to hear tough love at the end of the day too. And so make sure, as Steve was saying, the independent seat is also very important to give you the straight shoot of like, nah, you're going to have to let this person go, or no, you're going to have to cut like 20% of your staff, or, you need these people around you and not just yes people. That's super important for the longevity and the success of your business.
Good. All right. Briefly, who gets equity in a startup? Founders, co-founders, investors, key employees, advisors, service providers. So this is the concept of how to allocate equity is a really important conversation. It comes up all the time. And so I've included a really good article on how to actually distribute equity in your company the right way. And this is very important to get right. You don't want to make promises, hey, if you do this for me, you'll get 5% of my company. Even though it's not in writing, technically that might be an oral contract. So be very careful about promising or discussing equity until you've had a very thoughtful, advised process on how that's going to look, because it can have ramifications later in your funding structurally. So don't talk a lot about equity until you really understand how that's going to be done and why. I'm going to skip this one. So vesting agreement, again, you've probably heard about this, but the theory is that particularly founders will not be vested in their entire equity allocation at the initial issuance. They'll be allowed to essentially earn that over time. And so again, having a proper employment agreement and vesting schedule with key team members to make sure that their allocation of equity and issuance of equity is aligned with their contribution over time is really important. You got to get this right. There's a great article on vesting agreements. Fast agreement, similar to a safe note. It's a great, easy framework to use potentially for guiding your equity allocations to advisors. And so there's a link to the FAST agreement article and an example. But again, similar to a safe note, the FAST agreement is designed to offer a relatively easy to understand, easy to use framework for equity allocations to advisor. So I just want to make sure you knew that there was this resource in place. It may not be what you ultimately use, but it might be a really good guide. Cap table, we've all heard about cap table. It's really important that you have a detailed listing of exactly who has equity, what type of equity, what percentage of equity, what number of shares. So CARTA is considered one of the industry standards. They've got a great article on what is a cap table. So that's going to be important in your due diligence, and just generally important for you as a founder to have is a really detailed understanding of all the equity allocations that your company has outstanding. Good. Let me see what we've got next. Woo! We've made it. All right. Perfect timing. So this is our time for open Q&A. So we've gotten through all of our core content. Thank you, panelists, for all the color commentary. And really, this is your chance for asking the panel questions. I'm actually going to come off present so I can join you guys on video. And I'm actually going to seed the first question because this is a question I have. And then hopefully, Cameron, you can pull some questions from our existing Q&A, or you guys are welcome to also share new questions with our panel. But we're going to have a hard wrap no later than 1:30. So we've got about 17 minutes, up to 17 minutes. We don't have to take all the time. But it's clear that we have some great expertise. So this is your time. This is your opportunity. No questions out of bounds. And we can just get all your questions answered. So I'm going to go ahead and come off share screen and stop share. Perfect. All right, good. So I'm going to ask our panel the first question, which is, I'm very curious, is how important are detailed financial projections when you approach an investor? So you have your pitch deck. How important is it to have detailed projections, even monthly projections for the first 2 years as you approach a potential funder? So I'd love to get Tim's thoughts and Steve's thoughts on the importance of projections when you make that pitch.
Yeah, I think there's probably 2 or 3 things for me at least. So number one is I don't like it when I see like year 1, year 2, year 3. That just tells me you don't have confidence in when you're going to make that money. And so just have a point of view and say, hey, look, in 2024 I'm going to make this, and 25 I'm going to make that. So that's number one. Number two is it doesn't need to be that detailed, at least at the early stages. If you're at pre-seed or seed or even Series A, I think at least at first glance, what I would anticipate is you get a basic income statement. I know what your top line is, your gross profit, G&A, what your net income is, and what your monthly burn, right? I need probably 5 to 7 data points to understand roughly what your business is going to look like. And of course, in the data room, maybe, or later on, I would ask, do you have other financial data points to give me more comfort in terms of you understanding your business and having a real strong handle of the financial aspect of it. Those are the really 2 big things for me. And then obviously, as you get later on in the life cycle of your business, yes, you will be expected to have a lot of that data from day one. But really, for me, at least, I just want to know directionally where you are and where you're going.
Yeah, let me follow on with that, and I'll be repeating some of what I said on Tuesday. But the financial model, I agree completely with what Tim said. Kind of 5 years. Tell me what years they are, not some arbitrary year 1, year end, right? And the income statement needs to be the income statement that is common in publicly traded companies. Look it up. It's not hard, because I see so much stuff come out that what I believe is an income and expense statement that is the QuickBooks standard that tells me facilities and payroll and tax, and that doesn't help. It's irrelevant. Okay, you need it to run the business. I get it. And I'm going to say have 2 sets of books, not that they're different from each other, but they're reported differently. And use the one that starts with revenue, cost of goods sold, gross margin, operating expenses, R&D, sales and marketing, G&A. Okay, that's the number one. Like, don't miss that. The second one is know the guardrails of the industry you're working in. Okay. If every successful company in this industry has required spending of at least 30% on sales and marketing, don't say you're going to spend 5 and make $1 billion. Or if you do, have a really super amazingly compelling explanation as to why you're going to be totally different. And then the third thing I would add in there is don't promise something that only unicorns have ever done. I love the 5-year financial forecasts that come in that show me revenue growth faster than Twitter with operating margins better than Google's. Like, okay, you have simply no clue of the industry you're operating in, and there's no way ever I would work with you because you're too lazy and you're too arrogant. Not that I feel strongly, but whatever. Hendrik, what's your experience?
Hendrik, thoughts on the importance of projections when you make your pitch?
Well, they're projections. So I think that's important to understand that they're projections. And the earlier you are in your life cycle as a company, the more projecty those projections are. I think that's important. I think the more you can prove that hypothesis that your projections are correct with market research, with building prototypes, with getting sort of like price elasticity done, like getting all of that together, the earlier you are, the better. But truly, I mean, they're projections. Once you're hitting, in my opinion, once you're hitting sort of like getting close to Series A, or once you're like really in Series B territory, I mean, that is then all financial reporting and accounting, and by that point, this should all be sort of like really heavily automated and heavily sort of like on like a reporting / treasury stream. But early on, these are projections. And I'm not going to argue about my projections. Sorry. As a founder, like, these are my projections. If you don't like my projections, let's sit down and let's take a whiteboard and you tell me your hypothesis why my projections are crap. So sounds great. Let's work together on building better projections. But that's in my opinion, that's the beauty of like sort of like the primordial stages of sort of like pre-seed, seed. You're trying to get there and you're trying to understand where this journey is going.
Yeah, on that, Tim, have you ever seen a company that actually made its projections, adhered to them?
I've only heard of one.
Yeah. Okay. It's just one, as Hendrik was saying, it's just one version of what won't happen, right? But it's got to be a version of what won't happen that's backed up by logic, right?
Yeah.
If you're forecasting $2 million in ARR next year, and your average selling price is $200, and you're going to do it with direct sales, there's no logic to that, right? This is an impossible business. It makes no sense. And to riff on something both Tim and Hendrik have brought up on this hour, being pushed on your projections is a good thing, because what you're demonstrating to your potential investor is how you think, how you adapt to new information, how you will be resilient when the world changes, because the world will change.
You know, just so thank you for those comments, and I'll just throw mine in. Is remember that the numbers are based on a series of assumptions, and so it's less about the numbers; it's more about evaluating your assumptions and the ability to really explain and justify those assumptions. Is probably where the magic is in presenting the numbers. Well, good. We're at 1:20 now. Cameron, I've not been monitoring the Q&A or chat. Do we have any pending questions that we haven't responded to that we might be able to put forward?
I don't think there's any directly tied to this. I do pose, if there are questions, feel free to throw them in the chat, or simply you can come off of mute and share your burning questions. But
I've got one final one for each of Tim and Hendrik, and then if anyone's got them. So you've got a Zoom screen full of aspiring entrepreneurs here. Hendrik, think about your younger self 15 years ago doing your first startup. What would you tell your younger self, or what would you tell this group about ways to do it better than you did?
Oh, how many curse words can I use? No, I mean, I wouldn't trade it for anything. I think I wouldn't trade it for anything. I think it's a fantastic journey. Look, with the companies that have gotten acquired, I sort of like got my 366 days in corporate in between, and I once again I figured out it's not for me. What could I tell my younger self? I think patience. I think during the time of building the first company, like in between, I had my first kid as well, and I think sort of seeing the similarities between building a company and raising a child. I think I'm seeing like very striking similarities. Like there's a lot of commonality here. So I think patience is one of the key terms, and exercising patience much earlier is probably um of great interest to yourself, sort of like defense mechanism. Um, am I good in exercising patience? Still not. So, um, but now I have a daughter who actually can like who tells me like, Dad, you should be more patient. So, I again, I think it's and I think the other thing, the business that I ran in between, Infima, I was not the founding CEO. I was the hired gun CEO. I also learned that that is a very, very different business of being the hired gun versus being the founder. I think the emotions are very, very different, and I think um, certainly interesting. But I think again, being a founder, sort of like having your fingers in the dirt very early, losing fingernails, like building your calluses. I think there's just something that I love about that. But I think if I would sum it up into one word, it's probably patience.
Great. I did see a couple questions here. I want to let's see if we can pose. Jane asks, can you consider someone on your advisory team who you have worked equity shares with, also someone on your team? Well, I mean, my perspective on that is you have a core founding team, and then you might have an advisory board or a set of advisors. So oftentimes what I see on a pitch deck is two slides. One would be, say, leadership team, and those are the company operating officers, and then advisors. So I would say it's appropriate potentially on either one of the slides to put that individual. Jeremy asks, early on, what are the key components to collaboration to focus on maxing out with my strengths and filling my weaknesses with strategic partnerships? If I have the context, Jeremy, at least my thoughts on that, I'd be happy to get any other perspectives, is when you think about filling weaknesses, the first thing that comes to mind is core weaknesses on your team. And necessarily that wouldn't be with strategic partnerships. I guess it would be. There's a concept oftentimes ballied around is, do you have a complete team? In other words, does your leadership team, is it comprised of the critical skill sets that are required to drive and execute your business model? So maybe think about a complete team. Now, could some of those gaps be filled by partnerships potentially? But I would say that most investors want to see your core management team has the complete set of skills necessary to drive the model forward broadly. But I'd be happy to get some additional thoughts on that.
I mean, partnerships, again, partnerships, I would like to sort of like throw something in there. You get out of a partnership what you put in. That is, and that just may sound like sort of like your typical advice, but um, 2 companies ago, we entered into a number of large scale partnerships with distribution partners. 2 out of the 3, we didn't get anything out of it. And the third partner actually ended up acquiring us because we literally did all the work for them. They're a partner. They're getting their paycheck from not from you. They're getting the paycheck from the company that they work for. And especially if it's a sales and distribution partnership, the sales guy only has a certain amount of hours in their day. They may or may not get compensated on the deals that you can help them facilitate, but you need to figure out a way on how to make them a hero and literally spoon feed them the information, help them setting up webinars, help them set up seminars, help them. They're good in holding a Rolodex full of names. That's sort of what you need from them in a distribution partnership, and you need to do the rest of the work and then make them look like a hero on the other side. If you can figure that out on how to write that playbook, execute that playbook, and make the other person look really, really good, then that is a working partnership. But partnerships take a lot of work. It's not just like, here, I'm signing you up as a partner and you do this for me. Never works that way. Same with advisors. You need to give advisors a very, very certain job and measure them with KPIs and check in on them, and then basically go in and work with them. They're at this point, they're an advisor, sure, sounds good, but they work for you in for equity in an advisory capacity, and you need to be extremely specific in what you want out of them. Anything that is generalized will never work.
Let me jump in here. It's 1:27 and looks like we're done with the questions. Might be a good time to wrap, Cameron. So first, I want to thank all of you for investing your time today to participate. It's been great. I want to pay a particular thank you to Tim and Henrik, and also Steve, for their contributions today. And also, we value our partnership, Cameron, with Carson Center. And so at this point, Cameron, I'm going to send you a PDF copy of this presentation with the links that are live for distribution. And I will turn it over to you for any last thoughts.
Awesome. Well, we'll give the virtual round of applause. Thanks for leading the charge, Steve and Paul. And then thank you, Tim and Hendrik, for joining us this afternoon. Great knowledge and insights. And I know that this content will continue to add value not only to the founders here, but to those that come across the content and able to dive into it. So do appreciate the continued support and partnership with Tech Futures Group, and for all of you founders taking the risk to be entrepreneurs and building something great. And look forward to continuing to be in your corner. And wrapping up, we will follow up with the recording of this session, as well as the PDF slides. If you weren't able to join us for the prior sessions, we do have this as a playlist on our YouTube, so you're more than welcome to plug in there, and we'll share the various slides that have been shared throughout the last 2 weeks. But we appreciate the time and energy, and thank you all again, and look forward to seeing you about the ecosystem. So thank you all.
Awesome. Great job, everybody.
Thanks, everybody.
Wonderful.
Take care.
Thank you.
Thank you.
Bye.